Hey, what's up, YouTube? It's Flexing Joe, and I am here with a very highly requested EDU series that I'm going to start about how I chart and trade off of gaps and gap fill levels. So before I get into it, though, I do want to give a shout out to my #1 listener, my Sammy boy right here, Mr. Samson George. He just turned 7 yesterday. He's always there for my podcasts with Robbie. For any of these videos, he watches me trade. He's #1 listener from day one right there. So shout out Sammy. Happy birthday, buddy. So, and he did have some good cake too. Shout out to my wife for making it. So let's get into the gaps. Let's get into the charts, and let me explain to you how and why I draw these gaps. So first things first, how do I draw them? I draw them from bell to bell. 9:30 New York open to the 4 p.m. close. Okay. So the reason I do that is because it is, #1, the most consistent, and #2, it is when you have the highest volume of orders every single day. So if we go down to a 10-minute chart, like let's take, let's just take a random day. I don't want to use like an earnings day or something abnormal. But if you use like a random day, here you'll see highest volume of orders, really, actually it's second highest. But really high volume order area here, and then again at the close, right? Look how the last 10-minute candle is very high compared to the majority of the rest of the day. If we just go to like the day prior, super high volume on the first candle of the day, and really almost your second highest candle here at the end of the day. So it'll vary a little bit from day to day, but generally speaking, that's where the majority of the orders are. And on most tickers, like you know, you're gonna see that happen. Boom, here highest, and then it's your third highest. So it's very consistent. The other part of it, right, with saying that it's consistent is it's always bell to bell. It's always the same way. Now, there's one little nuanced thing, right? Is that I have to go to the 30-minute time frame or lower. I can't use the daily chart, and there's it's like a little like, I don't know, kind of a painful thing to deal with, but I just like to be precise. Sometimes it can be a couple cents off, right? Like this closing price was 176.32. This opening price was the same, so okay, that one works. This closing price was 179.53. Opening price was 179.51. So you see that like this is off by just a few cents, right? And so this is on 7:30. So I'll mark, again, this would be the closing price, 179.53. If we go to the daily chart, one thing you'll see that makes this kind of a pain is that if you go to the daily chart, right, you can already see it doesn't quite line up. If you go to here and you hover over this, it says the closing price was 179.51. And if we go back to the 10-minute, it's because it attributes the closing price to that opening price of the first candle after the close. So again, I always go bell to bell. When the bell rings, what's that last price that we had right there before the close? And you have to mark that on the 30-minute chart or lower, right? So again, if we use the 30-minute chart, wait, where were we? Right here. Sorry about that. Here we go. You see it is magnet mode, 179.53. If we moved it here, it'd be 179.51. So it's just, again, it's a little nuanced thing. Sometimes it matters. Most of the time it doesn't, but sometimes it matters. It matters. And I'm going to show you an example of that in a moment. So, again, it's always bell to bell. In this case, what I would do is, and I always draw it with a fib, I start where we closed, I go to where we open, and boom, that's it. Now, you can see that this gap was filled on the same day. So what I would do is, this is just how I draw them, is I turn off the right extension, I change the end time to really any time after 4 p.m. just so that it stops the drawing, and then I can have this to kind of to use and to see for reference. So I always, just as far as fib levels go, will leave the 50 and the 61. If the gap is large, I will add in the really it's the 0.768 or 0.786, right, for this one here, but this is a smaller gap and you can see we don't need it. Now, looking at this, right, what do we see? We had a gap up overnight, and we immediately filled that gap in the first 10 minutes. Let's go back to the 10-minute chart to view this. And a lot of times you'll see more information on the 10 or the 5-minute chart. So we had a gap fill. We had this big doji. It came up here, right? It closes down here. You're seeing some indecision. We push back up into the 50, and then we push to the other side of the gap. We come down, we consolidate here in the 50, and ultimately the gap fails. Again, we reject the 50, and then finally we flush off, right? So you'll see that like these are typically the areas that get a lot of interaction, and you'll see that price is just kind of doing, really just doing this like ping pong ball action through these levels before finally, you know, totally failing out, right? And throughout this whole thing, the buyers were trying to hold this up, and they were trying to hold this area, this gap up, but ultimately they failed, right? Because you have the opening print sellers overtaking kind of the closing print, the last 10-minute algorithm buyers, right? If you don't know this, at 3:50 p.m. every day, there is an algorithm that kicks on. It usually triggers a large group of orders, right? They're called market on close. So you have market on close, market on open orders that get pushed through. That's why there's such high volume. And so these areas can become important. And I find that many times we will gravitate back towards that closing area in price and either sometimes wick through it or sometimes barely touch it, etc. I will go through more examples of this in the future, and we'll kind of look at individual tickers. But for the sake of understanding this, this is the importance of drawing it. Draw it with a fib, draw it from the close to the open. Always from the close to the open. Reason being always from the close to the open is that this would be the 100% mark here at the close, and this will be, you know, the 0% line, which is the open, right? That's where it starts. Because if you think about it, a 100% retracement means to go all the way back to the close. If we were to draw it the other way, and we'll do it like on a different day so it doesn't jack up that drawing. If we were to do it the other way and draw from the opening print to the closing print, so you would see that like, well, you can't retrace 100%. You're already there when the market opens. It doesn't look right, okay? So I know some people get confused on how to draw fibs. That's how you do it. Closing print to the opening print, all right? So let's get into some more rules about gaps. I have rules about how I draw them. I always draw them now with color coding. I didn't always do that, and then I got to started to see that when we have certain days of the week on certain tickers, or you have certain economic events, or you just have certain holidays or whatever, I wanted to be able to distinguish what's what at a moment's notice. I always draw it based off the same color from when the gap starts, okay? So whatever that day we closed. On Mondays when we close, into Tuesdays or into Wednesdays if it's a holiday or bank holiday or the market's closed or whatever. Monday starting is pink. Tuesday starting is purple. Wednesday starting is yellow. Thursday starting is blue. And Friday starting is green. So that means that whenever we have a 3-day weekend from Friday to Tuesday, it is green. Whenever we have a partial day, this is an important distinction. Whenever we have a partial day, right, we'll notice where the futures markets are open, but the regular stocks aren't moving. The regular stock market is closed, right? Or we have like these weird half days, right? If we have a half day on the market, I'll do like the 1 p.m. closing price. That's when the bell rang, right? If we have a day where only the futures market is open and the individual stock names are closed and they're not moving, I will draw the gap from Friday when we closed at the actual bell, like the real market bell, to when we open on Tuesday, right? I will be including all of that Monday price action into that gap. And if you look at your daily charts, like on the NASDAQ daily, you'll notice that those partial days do get rolled into the daily candle. So it makes sense what I'm doing there. Now, speaking of the NASDAQ, right? Again, I'm going to show you guys a messy chart. We'll just ignore that. We'll go to something blank here. Speaking of the NASDAQ charts, right? If you look at it, we'll go even onto a 5-minute chart. If you look at the NASDAQ chart on the 5-minute chart, you'll realize you can't just go to the end where the shaded area ends, okay? Because that's actually the 1610 candle, right? Which means that it closes at that 1615. The bell is already rung. So again, I always use a 30-minute chart. It's always very easy, very consistent. And let's look at what happened yesterday with the 30-minute close, the 4 p.m. close to the open today. So here's your 4 p.m. close. If you look at the very bottom of the screen, you say that this is the 15:30 candle because it opens at 15:30, which means it closes 30 minutes later at 1600 when the bell rang. So again, like I mentioned earlier, right? If you look at the closing price of this candle, right up here, closing price of this candle 33.25, opening price of this candle 33.75, right? There's a 2-tick little jump there. So I always mark from the close of this candle, you see the high volume and everything, to the open of the next candle. So this would be a gap that I have drawn on my charts. You see what happened. We opened, we came down, we respected not only this pivot and the golden zone of this gap up. This shows me that the buyers had strength. The fact that even after we wicked over the pre-market high and we came back down, and even though we had broken out, kind of like look fake out breakout type look, and we pushed back down, I'll go to the 5-minute chart so you see that. And the fact that they could not push this back down to fill the gap showed me everything I needed to know about how much strength there was from the bulls, right? So here's the pre-market high. You see the little wick above. They wicked above, they flush it back down, the golden zone holds, and they push back up. So the other thing that I do with marking gaps to make it easy for me to understand what's what is, of course, I put in a title. So this was not a news gap up, but just a 8.5 to 8.6 gap up. Okay, so I mark that, and then the next thing I do is I will mark from where the gap started, where the candle closed. This is 15:55. 5-minute candle to the open of today, to the low of today in RTH. Okay, this is the portion of the gap that is not filled. I also will label it. I will title it unfilled, and I will send it off to 1 year in the future. Now, you see how this is really bright, kind of obnoxious? I go back into the HSV settings and I put it around a 70 on the transparency, and it makes it much more easy on the eyes. But also, I know immediately which part of the gap is left to fill. Sometimes we will get a gap up and it'll barely wick down and almost the entire gap is unfilled. That's a big sign of strength because the bulls have stepped up and they said, hey, we're good. We want to keep buying this, and we're okay to buy this up here. And then sometimes you get this little retracement where, hey, it came back down into where these orders were, and that was enough. And sometimes you'll get a full gap fill, and then it'll just sort of like bounce right off and go. Right? It happens all the time, but I watch it, I mark it, and then I'm looking for, are we going to retrace that area? And there are so many times where we go back to those areas and fill orders, and we will just turn, right? And I'm going to show you guys a very, very powerful example of that on AMD in a moment. So now I have this gap here that's left unfilled, and I know, right, as an example, boom, we bounce right off of the golden zone of this gap, okay? So let's go to that AMD chart. I want to show you guys, again, a very powerful example on the daily chart. Sorry, I got all these. I'm going to remove all studies. We don't even need the volume, right? So if we go to, this is my default set on AMD. I realize that there's a lot going on here. You're like, holy smokes, like how do you even chart on this? Well, when I'm looking for them on a daily, I'll just turn all this off. I'll just go to, like a clear drawing set. And when I'm looking for, looking at gaps or looking at areas that are unfilled, right, I go to default. Now you can see, right, that AMD has been very strong because look at all these unfilled gaps it's leaving all the way up, right? Because once a gap is filled, I turn off the right extension for the Fibonacci retracement from the close to the open, and then I will, turn off. I will stop that drawing. I'll just adjust where that rectangle ends. So hey, the gap was filled here. Boom, that's it, right? And there are a few occasions that I'll get into in future episodes about where we may retrace back into a filled gap, but I don't want to get too far into the weeds today. I just want to show you guys another really, really powerful example of what happened with AMD right as it hit this low right here. So I'm going to try to zoom way in. Okay. And so what you see here is this is the low of the April 8th candle, okay? And it snapped back up and closed right back up here. Okay, so it pierced through the low of the prior day, closed back up here, also closed in the golden zone of this yellow fib, right? Which is believe it or not, is actually a sign of strength, because the thing it did beforehand was it finally filled this little itty bitty leftover yellow gap right here. Let me delete this little orange circle right there. So if we go back in time, what happened? There was a very large earnings gap up right here, right? And truthfully, this one should probably be, I like to draw earnings or any other major news event gaps that are sizable and that don't get immediately filled. I like to change them to be thicker, so that way I know, hey, they're of even more significance. Once I would hover over them, I would like read the name of it and be like, oh yeah, that was NFP, or oh yeah, that was CPI. That's important, especially on market gaps like ES and NQ. But in this particular case, earnings gap up here, right? Boom, they blow through this. Now what happens after the earnings gap? They come back up. What happens? We fade back down into the earnings gap. This by itself is its own video, right? Like we could talk about post earnings gap ups setups, like on its whole thing, and I'll make that like a separate video where I go through many examples. But in this case, you have a very, very clear example of it. It comes down back into the golden zone of this gap. Yes, it wicks a little bit lower, but where does it close? The same rules that you would see or apply on a 10-minute chart while doing a gap from yesterday to today. This applies on the daily chart when you're looking at a gap that's really taken, this was February 1st, so it took like 3 weeks to get back there, right? So it's important. It took 3 weeks to come back, and when they came back, the bulls are holding. You can see the bulls are trying to hold over this pivot as well. It wicked down a little bit. There's a lot of things that line up here that make sense. But one thing that happened then, after we came back down and tested it, you got 100% confirmation of the strength of this level, because it popped back up and it gapped up huge, right? Like that's a $4 gap up on a stock that's only $76. That's pretty big, right? I mean, what are we talking about? Like 5%, right? Yeah, 5.25%. And then what happened? Over the next few days, it came back down and it left just a sliver of an unfilled gap. And then what happened, right? What ended up happening? Where did we go? Came back down and we hit the golden zone of that earnings gap up again and filled that sliver. It was like 2 for 1. And we had already been very, very, very extended to the downside when you compare it to the EMAs and all that. And boom, you get the rocket the next day after the now's a good time to buy. And you guys all know how that played out. Okay. So big thing with gaps too is the key takeaway is how quickly it gets filled, if it gets filled at all. Okay. If it doesn't get filled at all, or only part of it gets filled, right, you can judge the strength of the buyers or the sellers by how much of it gets filled and how aggressive the move is, either down and away from it or up and away from it, right? Gaps not getting filled quickly is a strong trend or a strong presence by that market participant, either buyers or sellers. There is no law, right? There is no absolute in trading that says all gaps must be filled. There is no rule for that, right? And there are a lot of gaps that AMD has left in its wake, right? All of these, I would just need to extend these over more, but like you can see, I'll zoom in just to make it very clear, right? Look, purple gap up to here. It only went down about a third of the way, not filled. Closes here, opens here. This gap just barely doesn't get filled. And it pushes. When it comes back down, right? Look what happens. Like, look at the respect that you get from this opening print. Like, I mean, come on. Why did price stop right there at the top of a gap, right? We gapped down, we moved down, and we rocketed right back up. Next day, we gap up, right? Here, we have another gap up. Look what happens here. It comes back down, fills this just a little bit. Doesn't go, right? It doesn't go all the way through it, and it pushes up. That may never get filled. Closes here, gaps up to here, pushes up, but never retraces into here. The next day, it gaps up again. So you got another gap up again. It fills that gap, but still can't encroach on this yellow one. This is an unfilled gap again. That, again, like I said, I got to extend it out. Boom, extended. May never get filled. Here, right? May 9th to May 12th. Weekend gap, Friday to Monday. It's green. We come down almost halfway. It hasn't gotten touched since then. It likely may never get filled, right? So you see, so like this, for example, was a gap up, and later it got filled. I mean, it got filled like perfectly right here when this candle opened. So then when we opened right here, right, and we started to wick down, and we wicked down into the low of an older gap, right, that had already been filled. So you see that, like, it's probably kind of confusing. And let me go to like the clear drawing set for a minute. So there was a gap from this to this, right? This was significant because this was an earnings gap, right? So that's why on the other drawing set, you could see it was marked a little bit thicker than all of the other ones. What happens? Earnings gap down. It holds the earnings, the post-earnings opening price area of 107.60. It moves up into the golden zone. Cannot close above the golden zone, although it wicks over, right? And wicks do the damage. Bodies tell the story. It flushes back under. Second attempt, it wicks over. No closes over. Flushes back under. Third attempt, right? This is following the good news about tariffs, and it jumps all the way to the other side. Sellers step in, and it works its way through the rest of this gap fill until what does it hold? The same area. So now you see that where the strength is holding, it pushes back up, goes to the golden zone again, makes the higher low, goes to the other side, bounces off of this area, and then it just jumps. And here's another unfilled gap that may never get filled from the close to the open. It only went down about a third of the way. So I know I'm kind of rambling and I'm going on much longer than I intended to. Holy crap, we're at 22 minutes. But like, I've got years of data and back testing on this one, right? I completely understand, like, seeing this and seeing how the market moves to fill these areas of voided price. Now, somebody has brought up to me too that like ICT has this method of marking gaps. And what I will say that I have found with it, and this is again marking up on ES. Let's just create a new drawing set. Gap EDU. So it's my understanding that ICT has this this way of like marking new week opening gaps. I played around with it for a little bit. I'm not an ICT guy. I don't want to go rambling onto that topic, whatever. This isn't a video about him. But these new week opening gaps never get the same level of respect and consistency that I see. Although this one does look like it's pretty good. You see this on the 30-minute, boom, 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 boom. But then like, yeah. I mean, that one, of course, I draw one that actually like looks pretty good. But they never just get the same level of consistency and the reliability that I've gotten from always just going bell to bell, because there's a lot of factors that could be in here. And also too, like this is the 6,000 level, so there's a lot going on with that. Let's go on to like another week and see what we get. I'm gonna delete this one off. All right, new week opening gap. So the gap would be from the closing price right before when the market ends to the market beginning, right? And then, yeah, here you get a golden zone retracement of the gap, right? Again, right to like that 6,000 level, and it hasn't been touched since. So, let's see. Here's another one. This one's smaller. Nothing yet. Last but not least is, when do I mark a gap as being filled? If I'm only marking gaps from the 4 p.m. close to the 9:30 open, I'm only going to consider it filled during regular trading hours. That means that if in pre-market, we'll go back to AMD. If in pre-market we're trading through any gap levels at all, let's look at, let's look at this one. So we have a gap up from here to here. You see this bright green area is what's left that's unfilled, right? We only traded through that in the after hours from earnings, and then in pre-market, I don't consider that to be filled until we trade through it in RTH. That's the final piece of it. Because even though we've moved through it in pre-market, and even though we might have moved through it with more volume considering its earnings, it still won't consider it to be filled. And I know that based off of my back testing that consistently shows me those are areas of importance until they are filled and respected in RTH. One of my daughter's friends drives by the house and honks every freaking time, and sometimes it sets the dogs off, and here they are, they're barking and getting set off. So on that note, I'm going to wrap it up. Hit me up if you have any questions down below. I am going to do more of these videos, so I appreciate you all for watching. Don't forget to like and subscribe for more, because I'm going to be back with more of these, showing you guys how I use it, how I trade off of it. So appreciate you guys. See you in the next one.